Okay, so you want to own an apartment complex, buy a property, fill it with tenants, collect rent every month, and watch the cash roll in. People always need a place to live, leases renew. The building sits there, whether the economy is booming or weak. It sounds safer than a restaurant, simpler than a factory, and easier to understand than a bank. That is the dream. The problem is what happens between the dream and the reality. An apartment complex is not just a pile of units with rent checks attached. It is a leveraged operating business wrapped inside a piece of real estate. It sells housing, yes, but it also sells location, safety, maintenance, convenience, and stability while consuming debt service, repairs, insurance, taxes, payroll, utilities, turnover costs, regulation, and capital expenditure at the same time. On paper, it can look like passive income. In practice, it often behaves like a machine that works beautifully until one or two variables move against you, and that is exactly why this business attracts everyone, from first-time landlords all the way up to pension funds, private equity firms, insurance companies, family offices, and giant real estate investment trusts. The visible asset is simple. The economic system underneath it is not. The ownership fantasy usually begins with a basic idea. A tenant pays rent every month. Multiply that by 100 units or 300 units, and the income starts to look enormous. Maybe rents rise a little each year. Maybe you renovate a few units and charge more. Maybe the neighborhood improves and tenants cover most of the mortgage, while the building quietly appreciates underneath them. It sounds almost unfairly good. Then the first complication appears before closing: debt. You usually do not buy a complex with cash. Even wealthy owners rarely want to tie up all their own capital in one asset. So the business starts with financing, and a lender underwrites the deal based on purchase price, net operating income, property condition, local rents, vacancy, taxes, insurance, and your plan for the property. What matters immediately is not just whether the complex looks attractive, it's whether the income can support the debt, and that distinction changes everything. Because in apartment ownership, the building's value often flows from income rather than the other way around. The industry shorthand for this is the capitalization rate, essentially the unlevered return a property produces based on its current net operating income. A complex generating $1 million a year at a 5% cap rate implies a value around $20 million, while the same complex at a 7% cap rate is worth dramatically less, meaning apartment owners aren't just betting on rents and occupancy, they're betting on financing conditions, local supply, regulatory risk, and the entire pricing environment for income-producing property. Before you even reach that point, there's the gatekeeping process. And unlike opening a small online store, apartment ownership sits inside a dense system of lenders, brokers, inspectors, title companies, insurers, municipalities, housing codes, fair housing rules, zoning laws, and often rent regulations. Money alone is not enough. The seller has to agree. The lender has to approve. Insurance has to be placed. The title must be clean. And the city may require certificates, inspections, lead paint compliance, elevator permits, fire safety compliance, accessibility rules, and registration of every rental unit in the building. In some markets, a future rent increase is constrained by law. In others, eviction timelines can stretch for months, and the real business begins long before the first tenant ever calls with a maintenance issue. Now consider the entry price. A modest 100-unit suburban apartment complex in a decent market might list for $10 million in one city and $15 or $20 million in another, while a larger institutional quality complex can run into the hundreds of millions. But the purchase price is only the headline number. Add due diligence, physical inspections, environmental reviews, legal work, appraisal fees, loan fees, title insurance, survey costs, transfer taxes, and closing expenses, all of which land before the property starts working for you at all. If the plan involves renovations, you also need fresh capital for unit upgrades, lobby improvements, roofs, parking lots, plumbing, elevators, boilers, or HVAC systems, and then there's working capital, because an owner who closes with no cash cushion isn't an investor. That's a future emergency waiting to happen. A realistic acquisition might look like this. Purchase price of $12 million, closing and financing costs of $300,000 to $600,000, an initial repair budget of $1 million, and operating reserves of a few $100,000 more, meaning the all-in requirement climbs materially above the sticker price the moment you actually run the numbers. Most owners solve this with a capital stack starting with equity and debt, where a bank might lend 70% of the cost, leaving the buyer to contribute the rest, and every financing choice inside that stack, recourse versus non-recourse, fixed versus floating rate, interest-only versus fully amortizing, changes the underlying risk profile of the entire investment. Once the complex is yours, the obvious revenue stream is rent, but apartment economics become clearer when you see the full revenue stack. Base rent is the first and dominant layer, but strong operators build meaningfully around it. Parking can produce real cash in urban buildings with limited spaces. Storage lockers rent separately. Laundry rooms contribute income. Pet fees and pet rent add another layer, alongside application fees, late fees where legally permitted, utility reimbursements, furnished unit premiums, package lockers, and amenity fees, all expanding the revenue system well beyond one rent figure multiplied by 12 months. But the quality of that revenue matters just as much as its size, because some income is contractual and recurring, some depends entirely on turnover, and some is politically exposed and can disappear the moment a market softens or a regulator intervenes. Base rent tends to be steadier than application fees, parking may be resilient in one neighborhood and worthless in another, and a smart owner needs layered income while knowing exactly which layers are actually durable. Then the cost machine comes into full view, and the most dangerous misconception in apartment ownership is that the building mostly runs itself once tenants move in. Real estate taxes come first in many markets because they're both large and difficult to control. Insurance has become especially painful in recent years, with premium spikes in disaster-prone areas and tougher underwriting across the entire industry. Payroll may include a property manager, leasing staff, maintenance technicians, and security. Utilities hit owners hard when units or common areas aren't fully separately metered, and repairs, landscaping, trash removal, pest control, legal costs, marketing, and unit turnover keep draining cash, even in perfectly ordinary years. Above all of that sits capital expenditure, and this is where many amateur owners confuse a building with a bond, because a bond does not call at midnight when a boiler fails, a building does. Roofs wear out, elevators need modernization, pipes corrode, parking lots crack, and a property can look profitable right up until the exact year when 3 or 4 deferred capital items all arrive together at once, quietly turning a healthy income statement into a cash crisis the spreadsheet never warned you about. Now add debt service. Net operating income is what remains after operating expenses but before debt service, and it's the central figure lenders, buyers, and sellers all watch closely. But owners don't live on NOI, they live on cash flow after debt, and this is the structural shift from real estate theory to ownership reality. A building can show attractive NOI and still produce disappointing cash flow if the debt is heavy or expensive, while cheap financing can make a mediocre building look healthier than it really is for a while. In apartment ownership, leverage magnifies both intelligence and mistakes equally. That brings us to the central trap of this entire business. Apartment complexes are valued as stable income assets, so buyers often use debt to amplify returns, and that works beautifully when occupancy holds, rents rise, and capital remains cheap and available. The trouble begins the moment financing costs, capital expenditures, or regulation rise faster than rent growth, and suddenly the same stability story turns into a squeeze from both sides at once. Tenants can't absorb unlimited increases, the lender still wants its payment, the roof still needs replacing, and taxes and insurance keep arriving regardless. The building can be completely full, and the owner can still feel poor. Let's put real numbers around this. Imagine a 100-unit complex with average monthly rent of $1,800. At full occupancy, Gross potential rent runs about $2.16 million a year, and assuming 95% economic occupancy after normal vacancy, effective rental income lands around $2.05 million, plus another $150,000 from parking, laundry, and pet fees, bringing total effective revenue to about $2.2 million. Subtract operating expenses, roughly $1,200,000, across taxes, insurance, payroll, repairs, and utilities, and net operating income comes out to about $1 million, a number that looks genuinely solid on its own. Then debt enters the picture. If annual debt service runs $700,000, pre-tax cash flow drops to around $300,000 before capital reserves, and setting aside $150,000 for longer-term capital needs leaves the actual distributable cash closer to $150,000, meaning a property generating over $2 million in annual revenue can still leave the owner with a surprisingly thin cushion. And this isn't even the worst-case scenario, it's simply the normal year model. Now stress that same year, let occupancy slip from 95 to 89% during a wave of new supply nearby, offer concessions to attract tenants, and effective revenue falls by $180,000. At the same time, insurance renews sharply higher, taxes increase after reassessment, and one unexpected plumbing issue adds another $70,000 in cost. Net operating income drops from $1 million to around $680,000, while debt service stays fixed at $700,000, meaning the owner has effectively lost the entire cushion, and one more surprise turns cash flow negative outright. Nothing dramatic had to happen. No fire, no scandal, no total collapse in housing demand. Just a few ordinary pressures arriving together at the same time, and that is the structural trap hiding inside apartment ownership. The failure case makes this even clearer. During the low-rate boom years, aggressive Sunbelt apartment investors bought complexes using floating-rate bridge debt, projecting rent growth strong enough to outrun rising costs indefinitely. When interest rates rose sharply, insurance costs climbed, and rent growth cooled at the same time new supply hit several of those markets. Deals underwritten around cheap debt and fast rent gains got squeezed by exactly the opposite conditions, and once cash flow fell, distributions to investors stopped. Capital calls followed, and some assets were sold at deeply disappointing values or pushed into distressed restructuring entirely. The lesson wasn't that housing demand disappeared. It was that good demand never protects a fragile capital structure. On the success side, a useful case study is Equity Residential, one of the most established multifamily REITs in the country, built around scale, professional management, and disciplined capital allocation in supply-constrained urban markets. Scale changes the underlying economics, letting a large operator negotiate better service contracts, spread management systems across many properties, and access capital more efficiently than a small individual owner ever could. Another success pattern shows up in careful value-add investing, where an owner buys an undermanaged property, upgrades units, tightens expense control, and raises rents in line with genuine quality improvements rather than fantasy assumptions, creating real value when the purchase basis is sensible and leverage stays moderate. Time to pull it all together and answer the actual question: how much money do you make if you do this right? In the realistic steady scenario, that same 100-unit complex generates roughly $150,000 in annual distributable cash flow against a $4 million equity investment, a modest cash-on-cash return, even though the underlying building might be worth $16 to $20 million depending on the market, and a great deal of the real wealth case depends on loan amortization, rent growth over time, and eventual resale value rather than current yield alone. In the stressed scenario, the same property can slide from feeding its owner cash to quietly eating it instead, with no visible crisis anywhere on the property itself. So if you do decide to buy an apartment complex, remember the one thing that actually determines whether you succeed. It was never really about how many units you can fill. It's about whether your rents, your costs, your capital, and your timeline all stay in balance at the same time. Because the moment any one of them drifts, the same machine that built your wealth quietly starts working against you instead.